Okay, so we are starting a new topic, the next topic, which is called inventory. Okay, and obviously, as you know, inventory, in other words, it is called stock as well. Okay, any kind of stock, inventory, it's the same thing. Now, as I told you in the first day as well, and the
Yeah.
first and the second classes, everything in the financial accounting has an international accounting standard attached with it. Okay, so those are
Yeah.
basically known as IAS, right? Or the other word for these are IFRS as well. IFRS basically means International Financial Reporting Standard, and IAS means International Accounting Standard. So they just keep on, we can say competing with each other. So like one standard
Mhm.
becomes old, the other one comes into place. Okay, and
Okay.
as soon as the other standard goes into outdated, the other standards comes in again. Okay, so the
Okay.
accounting standard for this inventory topic is called IAS 2. It's much easier to remember like this, right? International Accounting Standard 2 is known as inventory. It tells us all the rules for valuation, what we have to do, what we don't have to do. Okay, so that's what we are going to study right now.
Mhm.
Okay, so first of all, let me talk about basically that how we value the inventory. Okay, so first let's talk about that. What does inventory value contain? Okay, so first we are discussing that what does inventory value contain. So always remember, all inventory, sorry, all inventory is firstly recorded on cost. So basically every inventory is basically kept on cost at first. Okay, now how do we calculate the cost, that we're discussing right now? Okay,
Mhm.
so cost basically has two things. Basically we have to ask two questions from the inventory. Okay, and then we have to see the answer that it gives. We can learn it easily like this. Okay, so the first question that is over here, that is basically all costs incurred in bringing inventory to its present location. Okay, and the second question that we are going to ask over here is all costs incurred in bringing inventory to its present condition. Okay, so both questions are very similarly linked to each other, right? But the thing is that first thing is that we have to consider is that present location, and secondly all costs that are incurred in bringing inventory to present condition. So two words are
Okay.
present location and present condition. Okay, so what happens is that basically present location, let's first discuss this first one. Present location has many words. Like what can be the cost if you think about some cost that are incurred in bringing inventory to the present location? For example, the delivery costs, the transport cost, delivery costs, right? Some companies purchase inventory from abroad, from out of country, right? They import inventory. So what happens is they have to pay the import duty as well, import duty, as well as they have to pay custom taxes as well, right? Any other kind of tariffs as well. In some countries, there is a custom clearing agent as well that basically clears their custom. Custom is basically when they, ask at the airport, like, what things does this have, and what does it contain, right? So all the investigation that is done, these are basically incurred for inventory to bring it to its present location, right? So
Okay.
because we obligate, it's an obligation for us that we have to spend on all these costs, because if we don't spend on these costs, our inventory will not be accessible to us, right? We cannot bring it to present location if we don't spend these
Yeah.
costs. Okay, so the first question that we have to ask inventory is all cost incurred in bringing inventory to its present location. Now what is the second question over here? Present condition. Let me give you a small example. Like you have seen many kind of furniture making business, right? They are a good example of manufacturing business. right?
Yes.
Now, for example, they might use the raw wood logs, right? They might have some people in the forest, right? They cut the logs in a very regulative environment, right? And then what they do is that they bring the logs to the factory, right? And now in the factory, they obviously they cannot use the logs as it is, like the way they came into the factory. They have to process it in some way, right? They have to apply some chemicals to make the wood long laster, right?
Yeah.
They have to use they have to basically finish them, they have to polish the wood, right, before being able to make the furniture. So all these costs, like, testing, treating, chemical treating, all these things, cleaning the wood and treating it if it is infected with any insect, etc. So obviously these kind of things are to be included in this second question, which is that all costs incurred in bringing inventory to a present condition. Okay, there are many other examples as well, not just furniture making or wood making business. There are a lot of other examples as well, but the point over here is that we need to understand what they actually mean. That's why I'm giving examples over here. Okay, so this might be asked in the MCQ, that what costs are incurred in the cost of inventory when we are calculating the cost. So the correct answer is these two lines. Okay,
Mhm.
so these two things consist of the cost of inventory. Now the main question over here is that how do we value the inventory, right? So let's talk about the valuation of inventory as well. So it's a very simple rule. This is a main thing of IAS 2, the International Accounting Standard 2. Valuation basically says that we have to value it lower of two things. Okay, first thing over here is cost, the things that we studied over here, these costs. Okay, and second thing is net realizable value. Net realizable value, in short
Yeah.
form it is called as NRV as well.
Yeah.
Okay, so again, how do we have to value the inventory? Lower of two things, cost and NRV. So in the question, if you're given a cost of 1000 and the NRV of 700, what you have to do is that you have to choose the correct amount of 700, because this is the lower amount. We cannot record on 1000. We have to choose the lower of both amounts. Okay. Now the definition for cost, I have already explained it to you. These two things basically is very much sufficient to learn about the cost. Now, what is the net realizable value? We need to understand this as well. Okay. So first, let's see that what the words actually means. Net, as you know, I discussed this in sales tax and discount as well. Net basically means anything which is adjusted, right? From a
Yeah.
normal price, if you deduct something, you arrive at a net amount. Okay. Now, what we are actually deducting, that I'll explain you in a while. What does this realizable word mean? Realizable is not that English word that I realized it's too late, right? Everything like that. It's not that. But this realizable word is actually relating with the cash you actually receive for that part of thing that you're selling. Okay, so realizable, you can learn it in a simple way, that the actual cash that we receive on arm's length for the transactions that we are doing. Okay, so what does it mean by actual value? That is the same meaning of the net realizable value. Let me give you a small example. uh, this is the thing that I'm going to tell you right now. This is the main focus of IS2, which is inventory. Okay, the reason why we are recording at lower of these two amount is the reason that I'm going to tell you right now. Okay, so what
Yeah.
happens is that normally cost remains normally the inventory remains at cost. There is no doubt in this, right? But what
Yeah.
happens is whenever there is a sudden decrease in the market value, it can be because of anything. I'm writing some reasons over here as well, but a sudden decrease in market value causes it to be sold on NRV basis. Okay, so why we are
Mhm.
reducing it to 700 and selling? Because the inventory might be damaged, right? The inventory might have a defective batch being created, right? Some things might have been defective while creating that specific batch, so we might have to sell it for a much lower price than the market price. Okay,
Okay.
now let me write some reasons over here. There might be a natural calamity. Okay, a natural calamity, for example, like floods, like earthquakes. Okay, so this might damage the inventory, like a tsunami, a flood, or an earthquake,
Yeah.
or a hurricane. This might damage the inventory, obviously. So one more reason can be sudden decrease in market value. Sudden decrease in market value. Okay, so these are the basic main reasons, like any kind of natural calamity. Also, one more reason, this is connected with this third one, that sudden decrease in the demand of the good. Because obviously you've seen in the market as well that as soon as the demand goes down, no one prefers to buy that product. Okay, and there can be some several other reasons as well. You might have studied in paper F1 as well, like the purchasing power goes down, and the supply and demand relations, all of that. So because of that,
Yeah.
this all
Yeah.
also happens, obviously. Okay,
Okay.
what we have to do, again I'm telling, is let me give you a small example that actually happened in this world. This is a practical example. So there was a Samsung phone. This is a very popular story. It was Note 7. This, you might have heard of this phone. What happened is that its battery started to exploding in people's pockets, right? Or anywhere it was, placed on a table, anywhere. Nothing happened, no sign of damage, nothing, no overheating, nothing. But just it suddenly, burst into fires. And many people reported deaths, unfortunately, as well, because of this incident. So obviously Samsung, what it should have done is that in the cost, just for example, its cost was $1,000 in the market. Just let's
Yes.
suppose this, okay? So they might have to spend some costs on it. The inventory might have been damaged, no one would buy them. The main reason for this would be sudden decrease in demand, because no one would require that phone, right? So
Yeah.
obviously they would have been forced to sell the mobile phone at a much lower price than the market, and that's why they might have to sell at their net realizable value. Now I'm coming to the main point: net realizable value formula. What is the formula for this? Okay, so always remember, it is basically expected selling price. Okay, and we minus from this the cost to sell. Okay, we minus the cost to sell, and we get the answer as NRV. And the same thing I'm trying to explain over here, that what happens is realizable is meaning the final amount that you get at arm's length for the transaction that you're doing, right? So final, what does final mean? Obviously the net word explains that all. That net basically means that we have to minus the costs as well. So Samsung might have to incur some cost on extra marketing, extra advertisement in the whole world, right? Paying to stores as well, different kinds of markets, supermarkets, mobile markets. They might have to pay some agents as well, so that their units of Note 7 mobile phone should be sold as soon as possible. Okay, so there are different kinds of costs. Let me write over here, like agents fees as well. Agents fee, uh, different kinds of examples, like agents fee, and then we can say some commission paid to supermarkets as well, right? Because obviously if we are selling in a hurry, we need to get rid of the stock as soon as possible, because it's of no use if even if we spend
Yeah.
more time. So obviously we need to spend some costs on it. And expected selling price, how will we get this? This will be whenever a valuer does the calculation. So there are many kind of expert valuers sitting in the market, right? They have expert knowledge of every area. Like there are experts for the coal mines, the gold mines, the silver mines, right? The mountain resources that we have, and obviously of the mobile phones as well, different kind of things. So these valuers have the best knowledge. That's why they give the expected selling price. That if we ask someone that, Mr. Valuer, how much would you expect this thing would be sold out for, he first will analyze the product, right? He'll see what kind of damage has actually happened, and after that he would give expected selling price. It would be basically a range like between $50 and $100. It might be
Okay.
sold in the market. Okay, so basically the NRV formula over here is expected selling price minus the cost to sell. This will give us the NRV, net realizable value.
Okay.
Okay, and I've given you different kind of example, so I hope it's a lot clearer than before.
Yeah.
Okay, right. So basically we're just done with 70 to 80% of the inventory chapter. There is nothing much to discuss over here. Just a last small thing is left, that is inventory valuation methods. This is the inventory valuation steps, right, that we studied over here, like on what to value, on what lower off, higher off. But some things are left. that is just 5 to 10 minutes discussion. So let us take a small break over here, like just 2 to 3 minutes. Okay, and after that we'll just discuss the last thing over here. Okay,
Okay.
great. Okay, so let's continue and let's discuss the last thing over here. Okay, and then we'll probably end the lecture in just 5 to 10 minutes. Okay, just a small discussion is left. So right now that we're discussing is inventory valuation methods.
Sorry, I'm looking at this chapter, and there is also like this thing like revenue opening inventory, purchases less closing inventory. What's that?
Yeah, that basically we'll study when we study the statement of profit or loss, right? So basically how I'm designing the syllabus is basically I'm connecting to different chapters, right? That's why I explained you the sales tax and discounts thing beforehand, and also the receivables and payables as well. So depending on the questions in the kit, the sequence, so that we follow the kit sequence as well, and the syllabus sequence as well. Okay.
And do you think that we can, finish all the chapters by, like, I think.
Yeah, I think we'll be done till I'll try my best to complete till 12 or 13 March maximum. Okay, just maximum 13th or
Okay,
14th
yeah.
March, not greater than that.
Is it possible?
Yes, yes, 100%. Because I'm
Okay.
doing this from 3 years. Many students I have taught in just 1 month as well for this F3 exam.
Okay,
Okay,
thank you.
so inventory valuation methods that we're going to discuss right now. There are
Yeah.
basically three kind of methods that are allowed in this financial accounting. The first method is known as first in, first out. Okay, so this in the short form is known as FIFO. FIFO, you can call it anything, but it's FIFO. This means first in, first out. Okay,
Yeah.
so what this actually means is, as you can see with the word, it will explain itself, that the inventory that came in the factory first will go out first as well, right? That means whichever inventory that came in before the delivery that was received firstly will be sold to the final customer as well on the first priority basis. Okay, we'll discuss the calculation of this in the next class, the Friday's class, because it has a very lengthy calculation. We have to follow a format as well. Okay, now basically there are four methods, but let me explain you. The second method is called last in, first out. Okay, last in, first out, but this method is not allowed in financial accounting. This is because of many issues, like once it was allowed in the older times, like in the 1950s, 1960s, or 1990s, people started to take very misuse advantage of this. Okay, like they started to did tax evasion and different kind of illegal things because of this LIFO, just showing their inventory at less value so that they're not taxed at high amounts. So that's why they decided to finish this LIFO forever. in financial accounting. But yes, you might have studied this in F2 as well. In F2 in the managerial accounting, yes, this is available over
Yeah.
there.
Yeah.
Okay. Now the third and fourth method are basically relating to the same thing. It is called average cost method. I'm
Yeah.
calling it AVCO over here. But the difference in third and fourth is that third is called weighted average. Weighted average. Sorry, 1 second. The full word for this is continuous weighted average. Okay. And the last one is periodic weighted average. So this is the only difference in this. Okay. And these are basically the three methods: FIFO, AVCO of continuous weighted average, and AVCO of periodic weighted average. The most least used in the whole world, okay, that is the fourth one, this one, because this follows a very old approach, which is not, practical in today's world. And the most one obviously is used is this first one and the third one. Most businesses adopt this first and third one. Now we'll
Okay.
study the further detail of these topics in the Friday's class. Okay. And we'll study all these formats that we have to follow. How do we calculate this FIFO amount? What the question actually asks us. Okay. So first of all, on Friday's class, we'll do these remaining things that's left, inventory valuation methods. And secondly, we'll jump on to the inventory exam kit questions. And then hopefully this chapter will be finished. And then in the next subsequent class on Saturday and Sunday, we'll discuss the further chapters, the non-current assets and the current assets. Okay,
Okay.
got it clear. So I hope today's lecture was productive for you. Again, any kind of confusion that you have,